Hey guys, welcome back. Now, there is a lot of talk right now about are we going to get a soft landing or hard landing? Well, what if in fact the recession is already here? Now, Cathie Wood and ARK Invest deal in the higher risk end of the market, which means they need a strong economy to do really well. And so when she talks, I would expect at least some positive narrative about how things will soon be recovering and getting better. Well, that didn't happen. This month, Cathie Wood was not optimistic at all, and in fact shared some very concerning data. And so in this video, we'll be covering the biggest takeaways, including why a recession is already here with no soft landing in sight. Then why the latest job figures that were just released were very misleading, even though the headline figure was very, very strong. And then we'll finish up with the top 3 charts that were shared, which show some very concerning things yet to come. Okay, so first up, remember ARK Invest have a whole team of analysts, and from everything they are looking at, things are not looking good.
We are in a rolling recession. It started 18 months ago with 2 consecutive negative quarters for real GDP growth at an annualized rate. And since then, one sector after another has stumbled. So housing, for example. Housing, by many metrics, is down 40 to 50% on a year-over-year basis. That is a recession. In fact, it's worse than a recession. We've gone back to COVID lows. We're not far from 08, 09 lows. And remember, the housing crisis is what started that global crisis off. Sales have stopped because interest rates, mortgage rates are approaching 8%. And many people are quite happy to live in their homes with their 2.5% to 3.5% mortgage rates. They're certainly not going to roll them over into higher rates. And then we have autos. Autos were hard hit during COVID. And we would have expected them to soar, but they have come back in and they are below par. I mean, this 15.5 million units is more consistent with a recession than a recovery.
And so according to Cathie Wood, we are already in recession. And she says from many metrics, housing is already down 50%, which for housing is huge. And she also pointed out that auto sales are struggling, but for me, one of the biggest things happening right now has to do with the bond market. Remember, bonds are one of the largest financial markets in the world, and it's where the vast majority of people's retirement money is. It's a core part of the 60/40 portfolio, it's meant to be a safe haven, and it's crashed more than it has in literally hundreds of years. For example, check out TLT, which is the 20-year bond, and from its all-time high, it's now down over 50%. And remember, this is bonds. It's meant to be the safe haven, and it's for the people that don't want the volatility of stocks. So completely unprecedented. Okay, next up, another of the core indicators that many of the top people follow is jobs. And this month's job report was very misleading.
Today's employment report was a big upside surprise after months of downward revisions. And this month was an upward revision to some of the prior months. So the upside surprise, I think, was 337,000 around that versus nearly double the expectation. So that's interesting. But here again, we have something for everyone. The household employment survey, as opposed to the non-farm payroll survey, suggested that employment growth was only 86,000. Now that tends to capture more small businesses. And so at the margin, perhaps small businesses are fraying. We did see in the ADP report this week that large businesses continue to lay people off, and the Challenger layoff rate also is up more than 50% year over year. So again, lots of cross currents.
So here's the thing with the jobs report. Now, the headline figure was 336,000, yet what people were expecting was 170,000. So the jobs were literally double what people were expecting. So this means a super healthy, strong economy, right? Well, not exactly. If we look a little bit deeper, things begin to look a bit suspicious. Firstly, when we separate the government jobs from the non-government jobs, we see that it's all government jobs. And the non-gov jobs did in fact see a massive drop. Now, you tell me, is there someone in the White House who, as part of getting re-elected, needs to show a strong and healthy economy? But there's more. When we split out full-time jobs and part-time jobs, we see that the full-time jobs did in fact drop, and all these new jobs were part-time. And so it's many people having to take on a second job. Now, does that still show a super healthy economy? Okay, to finish up, this month, Cathie did in fact share some very interesting charts. So let's finish up with the top 3. Okay, the first chart has to do with the money supply, M2, as money printing and money contracting has a massive effect on the economy and on asset classes. Now, to make this look even simpler, let me just add one line here, and this is just to mark the 0. And now you can see all of the data that's above the line, and this goes back all the way to 1960. There's quite a healthy range going on here. Then the big things to note, this is the insane amount of money printing that happened around COVID time. At one point, it was growing over 25%, which is pretty insane. And so obviously they've had to scale this back. And for the first time in a very, very long time, the money supply is negative. And you do actually have to go back, not just 1960 or 50 or 40 or 30, but all the way back to the 1920s to see what's happening right now. So this shows that this really has been a completely unprecedented time. And with money supply being negative, this is not good for risk assets. Now, chart number 2, and this has to do with the yield curve. So this one's called the 2s 10s, which is the 2-year and the 10-year. And again, let me just add this line here so you can see what a healthy functioning economy looks like with a normal yield curve. And then when the yield curve goes inverted, which doesn't happen very often, this is when we fall below this line. So obviously, there was a major event happening in 1980, which was before my time. It has dipped below a few times, and then this is where we're at right now. So one of the points to note is that it's not typically at the lowest point that we see recession. It's when the yield curve uninverts and starts going back to normal is what triggers the recession. So you'll see it here. This was the absolute worst. However, it's the uninversion that brings on the recession, and same here, the uninversion that brings on the recession. It was the same thing here, but a bit harder to see. So this was the lowest point at the time, and it was the uninversion that brings on the recession, which sent it even lower. And then here, from there, these were the lowest points, and it's the uninversion bringing on the recession. And if we look at right now, the yield curve may be uninverting as it's rapidly increasing back to 0. And Cathie Wood is saying that we're actually already in recession. And then third and final chart has to do with credit default swaps, which are basically insurance policies against a default. And when this spikes, it means that there's trouble in the economy. So obviously, again, you can see just how unprecedented COVID was. And we have seen lots of volatility. But right now, you can see very recently, these have jumped up. So again, it's just a signal that not all is right in the economy and people are taking out insurance against a crash. With Cathie Wood being in the higher risk sectors of the market, they need a strong economy to thrive. However, this month was far from positive. She believes the US is already in recession and the macro picture does not look good. She says housing is already down 50%, new sales have stopped, the auto market is struggling, and as we saw, the bond market is getting crushed. We saw that the latest jobs report was a bit misleading. Even though the headline figure was double expectations, we saw that it's all part-time government jobs, which does look a bit suspicious. And when you look at the M2 money supply, the yield curve beginning to uninvert and credit default swaps on the rise, it feels like the next crisis can't be far away. So there you are, guys. Hope you enjoyed. Now, unfortunately, this month was quite a lot of doom and gloom, but let me know your thoughts below. And just remember to get rid of 100% of the comment spam and trading bots that plague YouTube comments. We are trying out the new SuperThanks Commenting system. So to get your question or comment read and replied to, or just to say thanks, then use SuperThanks below. And if you did enjoy anything in the video, then drop a like and a big thank you to everyone who does. And I'll see you in the next video. Bye for now.